The Roth 401k is a type of retirement savings plan. It was authorized by the United States Congress under the Internal Revenue Code, Section 402A, and represents a unique combination of features of the Roth IRA and a traditional 401k plan. Since January 1, 2006, U.S. employers have been allowed to amend their 401k plan document to allow employees to elect Roth IRA-type tax treatment for a portion or all of their retirement plan contributions. The same change in law allowed Roth IRA-type contributions to 403(b) retirement plans. The Roth Retirement Plan provision was enacted as a provision of the Economic Growth and Tax Relief Reconciliation Act of 2001. Traditional 401k and Roth IRA plans. In a traditional 401k plan, introduced by Congress in 1978, employees contribute pre-tax earnings to their retirement plan, also called elective deferrals. That is, an employee's elective deferral funds are set aside by the employer in a special account where the funds are allowed to be invested in various options made available in the plan. The IRS sets a limit on the amount of funds deferred in this way, and includes a catch-up provision intended to allow older workers to save for their approaching retirement. These limits are adjusted each year to reflect changes in the cost of living due to inflation. For tax year 2014, this limit is $17,500 for those under age 50, and $23,000 for those 50 and over. Employers may also add funds to the account by contributing matching funds on a fractional formula basis, or on a set percentage basis. Funds within the 401k account grow on a tax-deferred basis. When the account owner reaches the age of 59 or one-half, he or she may begin to receive qualified distributions from the funds in the account. These distributions are then taxed at ordinary income tax rates. Exceptions exist to allow distribution of funds before 59 or one-half, such as substantially equal periodic payments, disability, and separation from service after the age of 55, as outlined under IRS Code Section 72(t). Under a Roth IRA, first enacted in 1998, individuals, whether employees or self-employed, voluntarily contribute post-tax funds to an individual retirement arrangement. In contrast to the 401k plan, the Roth plan requires post-tax contributions, but allows for tax-free growth and distribution, provided the contributions have been invested for at least 5 years and the account owner has reached age 59 or one-half. Roth IRA contribution limits are significantly less than 401k contribution limits. For 2013, individuals may contribute no more than $5,500 to a Roth IRA if under age 50, and $6,500 if age 50 or older. Additionally, Roth IRA contribution limits are reduced for taxpayers with a modified adjusted gross income greater than $112,000, phasing out entirely for individuals with a modified AGI of $127,000. See 401k versus IRA matrix that compares various types of IRAs with various types of 401ks. The Roth 401k plan. The Roth 401k combines some of the most advantageous aspects of both the 401k and the Roth IRA. Under the Roth 401k, employees may contribute funds on a post-tax elective deferral basis, in addition to, or instead of, pre-tax elective deferrals under their traditional 401k plans. An employee's combined elective deferrals, whether to a traditional 401k, a Roth 401k, or to both, cannot exceed the IRS limits for deferral of the traditional 401k. Employers' matching funds are not included in the elective deferral cap, but are considered for the maximum Section 415 limit, which is $51,000 for 2013. Employers are permitted to make matching contributions on employees' designated Roth contributions. However, employers' contributions cannot receive the Roth tax treatment. The matching contributions made on account of designated Roth contributions must be allocated to a pre-tax account, just as matching contributions are on traditional, pre-tax elective contributions. In general, the difference between a Roth 401k and a traditional 401k is that income contributed to the Roth version is taxable in the year it is earned, while income contributed to the traditional version is taxable in the year it is distributed from the account. Furthermore, earnings on the traditional version are taxable income in the year they are distributed, while earnings on the Roth version are not taxable ever. There are restrictions on the non-taxability of Roth earnings. Typically, the distribution must be made at least 5 years after the first Roth contribution and after the recipient is age 59 or one-half. A Roth 401k plan will probably be most advantageous to those who might otherwise choose a Roth IRA, for example, younger workers who are currently taxed in a lower tax bracket, but expect to be taxed in a higher bracket upon reaching retirement age. Higher income workers may prefer a traditional 401k plan because they are currently taxed in a higher tax bracket, but would expect to be taxed at a lower rate in retirement. Also, those near the Roth IRA income limits may prefer a traditional 401k, since its pre-tax contributions lowers modified adjusted gross income and thus increases eligibility for Roth IRA contributions. Another consideration for those currently in higher tax brackets is the future of income tax rates in the U.S. The Roth 401k offers the advantage of tax-free distribution, but is not constrained by the same income limitations. For example, in tax year 2013, normal Roth IRA contributions are limited to $5,500. Whereas, up to $17,500 could be contributed to a Roth 401k account, provided no other elective deferrals were taken for the tax year deferrals taken. Adoption of Roth 401k plans has been relatively slow, and stated reasons for this include the fact that they require additional administrative record-keeping and payroll processing. However, some larger firms have now adopted Roth 401k plans, and this is expected to spur their adoption by other firms including smaller ones. Additional considerations: Roth 401k contributions are irrevocable. Once money is invested into a Roth 401k account, it cannot be moved to a regular 401k account. Employees can roll their Roth 401k contributions over to a Roth IRA account upon termination of employment. It is the employer's decision whether to provide access to the Roth 401k in addition to the traditional 401k. Many employers find that the added administrative burden outweighs the benefits of the Roth 401k. The Roth 401k program was originally set up to sunset, or no longer be in place, after 2010 along with the rest of EGTRRA 2001. The Pension Protection Act of 2006 extended it. Unlike Roth IRAs, owners of Roth 401k accounts must begin distributions at age 70 and a half, as with IRA and other retirement plans. See also, 401k, comparison of 401k and IRA accounts, 401k and IRA comparisons, 403(b), individual retirement account, Internal Revenue Service, rollovers as business startups, self-directed IRA, references. External links, designated Roth accounts in 401k or 403(b) plans, information from the IRS website. IRS Publication 4530, Retirement Plans FAQs regarding designated Roth accounts, Smart Money, Understanding the Roth 401k.